Okay, so today we are diving into an ETF that has some truly, and I mean truly, eye-popping numbers. We're talking about yields well over 100%, sometimes even pushing 200%. And when you see numbers like that, it makes you ask a very simple question. What on earth is going on here?
And hey, if you're thinking that, you are definitely not alone. This exact feeling, perfectly summed up by a user on Reddit, is pretty much what kicked off this whole explainer. Are we all missing something, or is there a catch?
Yeah, it's easy to see why people are skeptical. I mean, when you see a number like this, a trailing 12-month dividend yield hitting almost 19.5%, your too good to be true alarm bells shouldn't just be ringing, they should be screaming. So let's figure out how a number like this is even possible. So what is the machine behind this crazy number? Well, it's an exchange-traded fund, an ETF, with the ticker symbol MSTY. It comes from a company called YieldMax, and its whole reason for being is to squeeze high monthly income out of a very famous and very volatile stock, MicroStrategy. The secret to this massive yield isn't some kind of financial magic, but it is a pretty complex strategy. Don't worry though, we're going to pop the hood and break down exactly how this machine works piece by piece. At its heart, MSTY uses what's called a synthetic covered call. Now, a regular covered call is pretty simple. You own a stock and you sell someone the right to buy it from you later at a higher price. For selling that right, you collect a little fee called a premium. The key word here, the real twist, is synthetic. That means the fund does this whole dance without ever actually owning the stock. It basically works in 3 steps. First, the fund uses a bunch of options to create a position that acts just like it owns MicroStrategy stock. It goes up when MSTR goes up, down when it goes down. Second, it starts selling call options against that fake position to rake in those premiums, and that's where that giant monthly payout comes from. And finally, to make sure the whole thing is secure, it holds super safe US Treasuries as collateral. So this is the point I really want to hammer home. When you buy a share of MSTU, you do not own a single tiny piece of MicroStrategy. You're not a shareholder. You don't get a vote. All you're getting is exposure to its wild price swings through this complex web of options.
But, just like our friend on Reddit suspected, there is a catch. Of course there is. A yield this high doesn't just appear out of thin air. There are some huge trade-offs that you absolutely have to understand before even thinking about this. And here it is. This is the core trade-off. Because MSTY is constantly selling away its potential for big gains to earn that income, its upside is capped. If MicroStrategy stock goes to the moon, MSTY only gets a tiny little piece of that ride. But, and this is the scary part, if MicroStrategy stock crashes, MSTY is exposed to all of that loss. Your gains are limited, but your losses are not. It's a completely lopsided bet.
So that should make you ask a really important question. If the fund is giving up most of the potential profit, where is all the cash for that massive monthly payout actually coming from? It can't all just be from selling options, can it?
And the answer is no, it can't. If we look at one of the fund's own reports, we see that a huge chunk of a recent distribution, over 60% of it, was something called return of capital. You know what that is? That's a fancy accounting term for the fund literally giving you your own investment money back and calling it a dividend. It isn't profit, it's a refund.
This whole process has a name. It's called NAV erosion. When a fund pays out more than it actually earns, especially by just handing you back your own money, its share price, the net asset value, is basically designed to go down over time. So while you're getting those big checks in the mail, the actual value of your investment is very likely shrinking.
So to really understand this thing, we need to look at what's powering the whole engine. What makes this high-yield, high-risk strategy even possible? It all comes down to the crazy volatility of that one company, MicroStrategy. So yeah, MSTY is a bet on the wild price swings of MicroStrategy. But let's go one level deeper. What is MicroStrategy these days? Well, the company has famously bet its entire future, its entire corporate treasury, on buying and holding Bitcoin. For all intents and purposes, it's become a proxy for Bitcoin itself.
And another commenter just absolutely nailed it. You have to look at the underlying's underlying. And in this case, the real bet you're making with MSTY, whether you know it or not, is on the price of Bitcoin.
And that intense crypto volatility is a total double-edged sword here. On one hand, it's what allows MST to sell options for such crazy high prices, and that's what funds those huge payouts. But it's the exact same force that creates that massive uncapped downside risk if Bitcoin, and therefore MicroStrategy, takes a nosedive. So, let's put it all together.
What is the final verdict on MSTE? How should you think about this thing? Is it a revolutionary income tool, or is it a high-risk trap waiting to spring?
Well, there are two completely different ways to look at this. The bull case is that it's a cool way to generate cash from a super volatile asset, a smart bet if you think MSTR and Bitcoin are only going up. But the bear case? Well, the bear case is that it's a sucker yield, a dangerously misleading number that hides the fact that your investment is melting away, all while capping your gains and exposing you to potentially catastrophic losses.
And most financial analysis tends to land on the side of the bears. One report called this triple-digit yield a statistical anomaly, not a sustainable income stream. Basically, it's a quirk of the math in the short term, not something you can rely on for the long haul.
And that really brings us to the bottom line, the most important takeaway. MST is a highly specialized, very high-risk tool. It's built for active traders, for speculators who get the options market and are totally comfortable with the idea of losing a lot of money. It is absolutely not for a conservative investor who's just looking for a safe, steady paycheck in retirement.
So in the end, the answer really depends entirely on what you're looking for. Is it a high-tech cash machine, or is it a high-risk house of cards? Are you looking for a lottery ticket or a long-term investment? That's the question you have to answer.